Hey everyone, John D. Relay, Head of Revenue Management Education at Wheelhouse here, and welcome back to the next session in our series of micro market magnifiers, where we look at market data to help you guys get ready for a great 2025. We're going to be doing this throughout the year for a number of different markets, so let us know if you'd like to see another market and you find this data valuable, or if you'd like me to speak to something specifically. Today, we're going to dive into the Orlando area, and specifically the area around Walt Disney World. In Wheelhouse, Orlando is a pretty big area. As you guys know, there's a lot of listings here. So we have this split up into a number of market areas. The one I'm going to focus on today is the market we call Walt Disney World South. It's got the majority of the listings in the area at over 18,000, so quite a lot of density here. We do have a few other market areas that we might touch on, but if you're looking at your listings and wondering, hey, I don't see Walt Disney World South, depending on where they are, we do separate Orlando, Walt Disney World North, and the Kissimmee areas. So there is quite a lot of different areas to kind of cover all of the listings in this region. We're going to focus on the Walt Disney World South because it is the densest by listing count. You can see we've got a significant portion of listings here. The other markets really are only in the 4,000 to 6,000 range. And because of the proximity, most of the trends we look at here are probably going to apply elsewhere. We may pull a couple up, but this is where we're going to spend the majority of our time. As kind of an overview, I like to look at these top level things. There's a few interesting pieces of data here. We are on the Wheelhouse Market Reports, which is available to everyone, Wheelhouse customers or not. So you can all access this kind of high level market data. And the first thing I think I'd like to bring up that's pretty important here is the active listing growth in the region. Orlando has been one of those areas, the Orlando area, that has had pretty substantial listing growth, and that's been pretty sustained. People have been saying, and if you've been listening or in the market yourself, obviously, you've heard that lots and lots of development on the vacation rental side has been going on in Orlando. Lots of people have been entering the market, and that's been going on for a couple of years since post-COVID. We've seen lots and lots of listing growth, and over the last year, that's no different. Coming in at about 12% increased listings, so pretty high. Now, increased listings are something that we've seen across a number of markets, some not quite as sustained as Orlando, and if you've been looking at a lot of macro data from some of the other data partners in the space, you have seen aggregate demand increasing consistently. The real question is, has that aggregate demand increased enough to cover all of the added properties? As you can see here at the top level, we're not seeing a ton of pressure, but we're also not seeing a ton of benefits. So over the course of the year, the average occupancy across the entire market has remained pretty static. Now, this lower number, 50%, is because we are looking at all listings in the market. But unlike some markets where we've seen a lot of growth, we're not seeing substantial decreases here. And that's a pretty good thing. Now, whether or not that's going to be sustained, we'll see. And the fact that we're not seeing growth, even though we know demand itself is growing, does indicate that there's a lot more pressure on the market. You can start to see some of this where if I switch this to just the high performing listings, which cuts this down to a much smaller percentage. We'll ignore the active listing count because this is just a slice. But you can see that the overall occupancy in the highest performing listings is significantly higher, as you would expect. Professional operators, people doing really well, they're going to keep their properties occupied much more of the year. But here is where we're really starting to see some of the pressure, right? So instead of seeing growth on this occupancy level, even in the top performers, we're actually seeing that the market share is shifting downstream a little bit. There's a lot more options, probably a lot more options for kind of budget or just more stuff in general. And we are seeing a little loss of occupancy year over year. Now, where this really becomes evident is if I look at the lowest performing. So you can see I've come down to the really lowest performing. Their market occupancy across this group is already going to be substantially lower. It's going to be really tough if they're in that space. And they've lost a ton of ground. So kind of an interesting movement with all of the increases in listings is you've seen the low end of the market really fall apart. They've lost a ton of the occupancy that they had available, and they didn't have near as much to begin with. And you're even seeing a little pressure at the top where people who otherwise would have had to spend at the higher end or buy a little higher quality product or maybe spend a little more than they want have a lot more product available that's kind of sitting near the middle. And I think that's pretty interesting as we look at the kind of data and as we think about what trends are likely to happen in 2025. I think at the back of everyone's mind is going to be, what is the pressure that the supply is going to have in this marketplace? The next thing I really want to dive into is how that occupancy has really existed over the last 12 months and kind of before. So let's take a little deeper look. I'm on the trends section where it's going to show monthly year-over-year data for a number of KPIs. Right now we're looking at adjusted occupancy, and I just have 2023 and 2024 pulled up. Mainly to kind of give an idea of how 2024 was different than 2023. Then we can start to qualify how 2025 is looking. When we look at 2023, we're obviously coming off the heights of COVID. Things are looking really, really strong across the board. People are making quite a bit of money, especially, coming out of 2022. But as we got into 2024, we started to see some of that pressure. And this is something that, if you've been following the macro data, kind of occurring all over the country, although not necessarily at the same level. Q1 being a pretty strong high season in this area, along with July, we started out the year seeing a lot of pressure on the occupancy side. Pretty significant decreases last year in January and February, little bit of losses in March, and a big drop off in April. Now, as we get into the middle of the year, that really starts to level out, start to see a little bit of stabilization. And at the end of the year, we actually saw some increases. That's pretty interesting. I think part of this is coming out of 2022 and 2023. People really expected better performance. Early booking was probably high too, because people who booked super early were paying the highest rates. That caused people to keep rates pretty high through the spring, and were only able to react in the short term, causing a lot of vacancy or a lot of lost rates. The story around Q4 and end of Q3, I think, is quite different. I think people already understanding that there was pressure got ahead of the market. And this is true not just in Orlando, it's true in a number of vacation spots where you see this kind of better performance across Q3 and Q4. Now, obviously, these are a little lower seasons, so you have a lot of room to grow, but I do think people also had lower rates to begin with, and they had them much earlier. By the time we had gotten into June and July, people were already pretty convinced that this was a tougher year, so they went ahead and dropped their rates early. We just didn't have that opportunity in Q1 last year. Now, I think those lessons are really important, though, because, it's really a mixed bag. I've seen a lot of people come out of Q4 and they're like, hey, I need to be more conservative next year. And they applied those lessons from Q4, which is more conservative rates, building a base of business, trying to pace earlier. They applied them to Q1 and Q2 this year. And some of them are saying their pace is pretty good. Now, I've seen the opposite too. I've seen people who really haven't taken these lessons and they're like, well, hey, next year's got to be better. High season's high season. I'm going to hold my rates. And it's really kind of up in the air how that's going to work out. But I do think when a market is under a lot of pressure from supply, when occupancy is kind of dropping at a macro level, and you also have potentially volatile macro trends that could influence demand, it's a more prudent kind of course of action to set a strategy that's going to be a little bit more conservative. There are some benefits there too. If things end up really well, you can still react if you've had a more conservative strategy. And I think it is easier to react in that way than it is to come into a time period and not be pacing well. Now, looking forward into the 2025 data, we can start to see a few interesting things. For one, we're obviously not reaching the heights that we hit in 2023, but we definitely are stabilizing into 2024 early in the year so far, which is good. January coming in just a little ahead of 2024, I think, is a really good thing. We're not continuing to see slippage there at the macro level. And it looks like February is really on track to be in a pretty similar spot. We look at 2024 and we're only 6 percentage points away. There's a third of the month left. I think it's very likely that January and February end up being pretty similar to 2024 performance. As we go forward a little further, though, I do have a little bit of concern about March. We're a little less than halfway to what we hit from an occupancy perspective in 2024. And we're 5 weeks till the end of March. We're we're really running out of time here. And once we get within that 30-day window, it's going to be kind of like all hands on deck for heads and beds. And I have some concerns here that we're going to see some attrition in March. We'll look a little later into some of the booking window concepts here, but I do feel like the market hasn't been pacing as well here as we did in these kind of lower seasons. Now, April, some of this is maybe because Easter occupancy is moving this year. And even looking forward into April, we do have some occupancy on the books. But again, I'm not sure that these numbers, like a very simple way of doing this, which, ignores a little bit of the complexity of the booking window. But if you just multiplied what we're at, by the number of weeks left, we're not quite hitting where we need to go, right? So once we get past this kind of February timeframe, I do have some concerns about the pace out here. Let's take a little deeper look and kind of look at the daily level illustration of that. So I'm on the Wheelhouse future report, looking at adjusted occupancy, and what we have here is the current occupancy and the last year's ending occupancy. So this is going to give us a more granular view of what we were just looking at, kind of going forward for the year. And I think what's most interesting here is this March period from March 7th to April 5th, really, is really shaping up to be quite different than it was the previous year. If we look at the previous year, you have these really big peaks here from March 9th to March 15th, and then March 23rd to the end of the month, and then we have Easter. And those peaks drove substantial occupancy. We are still looking at all listings in the market. We're not even just looking at the highest performing segment. And that market occupancy is hitting like 80% on those days. If I go to the high, you can see here that that's even higher at over, around 90%. And so those dates are really, really substantial revenue drivers last year. Seeing that we're only, for some of these dates, we're basically less than 30 days in, we are not seeing any of the same shape appear this year. Instead of seeing these big, huge peaks of demand, we're seeing a very flat downward trend. And this is really concerning to me. I would generally expect us to see a weekend weekday pattern by this point. I would generally expect us to see pretty significant demand spikes where people are going to travel, and they just don't seem to be appearing. Part of this could be because people are setting rates off of last year and the demand is different. It could be because of other trends. But if you're looking at your portfolio, this would be a big concern for me if you saw a similar shape. When I'm looking at a portfolio and I'm 6 weeks out, I really would expect to know by now which dates are going to be the best dates that I want to hold rate on and which time periods are going to be low occupancy that I can start to adjust. And if you're looking at your portfolio and you see that, you're going to be in a pretty good shape. But this overall market trend is something that would really concern me. Additionally speaking, we have this substantial drop here. So last year, this time period would have been Easter. This year, it's not going to be showing up as Easter. And you really want to make sure that you're pricing that correctly, because you're going to want to have to try to be the market on occupancy, because you're not going to be the market on ADR over those dates. You can see so far that those dates are nowhere near as strong of demand. And there's probably some opportunities to try to get ahead of the market if the market is pricing too high. Now, on the positive note, we do see pretty strong pickup for Easter. Right? Easter's already at 29%. That kind of puts us in line with the end of March and even mid-March, which, again, another concern for March. But the pacing seems to be pretty good for Easter so far. We'll take a look a little bit later at the rates and see how people are driving. But that does look good. As we go further out, we do see that, there's a lot less on the books. We do drop a little in this kind of end of May, which makes sense before the holidays. But overall, I think the biggest concern here is March. If we're looking at March, this difference between last year and this year's, the way this year is shaping up compared to last year would be a really big kind of red flag that your revenue managers should really be paying attention to this. We know there's more supply in the market, and maybe start to act more conservatively, especially if you haven't. Now, the other thing to keep in mind here is I wonder if in the market there's length of stay stuff going on, because we're just not seeing this weekend pattern that you would normally see at a market level. Very, very unusual. And I think something to keep in mind, and I'm going to switch this back to the all, is when we look forward into April and May outside of Easter, those time periods are generally lower occupancy than March. And when you're looking at that, if you're standing to lose some ground in March, I think it's very important to try to get ahead in those months. You might be able to make some of it back by being conservative, taking those lessons from Q4 where people started out lower and really trying to get the occupancy now for anyone who's looking, because chances are there's going to be vacancy in the portfolio. So really any additional occupancy you can get now is going to be incremental. Next thing I want to look at is just the asking rates. And I'm going to zoom in a little here. We're just going to go through June so we can see a little bit easier what's going on and really focus on this spring section. And I think what's pretty interesting about this is, let's call out the good stuff first. So if I'm looking at this here, we saw that Easter from an occupancy perspective was pacing well. Not only is it pacing well, but it's doing so at a really strong rate. This Easter rate is about equivalent to the highest March weekend before Easter last year. And that looks really good to me. I think we should all be pretty pleased about Easter's pacing and performance. If you're not seeing it in your portfolio, maybe something to look at. But it does look like the market is capturing really strong rate and really strong pace. Now, as we look at March, I think this is something that we maybe need to be concerned about, because you can see the market kind of steps up its price around the 9th and carries that price all the way through the end of the month. And if you recall from our occupancy look, around March 9th is where this pattern for weekend weekday starts to fall apart and really becomes an anomaly, in my opinion. And I think what this means is that the market is really rejecting the price position that property managers are trying to achieve. Now, unfortunately, that's pretty disappointing news. It means that the month is on track to really potentially underperform what it did before. But, at the end of the day, you got to get money on the books. You got to kind of do as much as you can to get the heads in the beds. And there's still probably room, because we do know that booking windows have been getting shorter, to drive some rate, but you just really need to make sure that your pacing is in position. Now, I do think something that is kind of interesting is, and I'm not sure if it applies to the Orlando area, but I've been hearing from other people in other areas that spring breaks are not all aligned this year because Easter's so late. You have different spring breaks. The different colleges' spring breaks are kind of moved around. And what that seems to be causing is a lot less pricing power for PMs, because you don't have all of this stacked demand on the same weeks. It's limiting the ability for the PMs to really drive rate. But what I am hearing on the other side is it is making more dates strong. So I think one of the things you might be able to draw from the other markets here is maybe you don't have the pricing power on the same weeks that you did, but if you're priced correctly, you can actually drive occupancy in other places, and that's going to make up revenue in the March area. The other thing I think that is important to point out, and I'm going to turn off the year over year right now. If we look at the spring and we look at April and May, outside of this Easter period, there really is a very limited difference in price between April and May. May is going to be the lowest, which I think makes sense. April is still pretty high, and we're really not seeing a big difference in the average in pricing. It's really, honestly, it's less than 10% difference. And I think that that's a huge missed opportunity. When we look at how it looked last year, you can see that that ends up being quite a bit lower in these periods, especially April. Like March is pretty in line, but April and May drop substantially compared to what we did last year. And when we look at the occupancy situation, the occupancies themselves are substantially lower and also have a much stronger weekend weekday pattern. You don't have these big whole weeks. I think this is something that we consistently see across Florida and Gulf markets and Eastern Seaboard Southern markets. Is there's an expectation that spring should be better than it is, and it causes people to overprice. I really encourage people to take the lessons from Q4, where people had started much more conservative and really were able to drive occupancy, and apply those to the areas of the spring. Because there's not really a reason to be holding your non-Easter April dates and May dates at 20 or 30% above what you actualize at, and then to have to compete with everyone else who's dropping their rates within 30 days. If you think that there's going to be a big shortfall in March, I would do what you can to get the heads in beds because we're almost just within 30 days. So there's a limit to what you can do. But really shift some of that focus to April and May and see if you can drive occupancy to kind of make up some of the gap. The last thing I want to show you guys is some really cool data that we have on the back end to kind of hammer home this idea of the booking window in March. So I have here, and this is just all the reservations, and we have this really awesome graph. And when we look at it, we can see how the bookings build up over time. And there's a few data points that I like to look at. So if we look at the end of the year, so let's go to December 31st. And right now, just so you know, we're looking at the 2024 data for March stays. So for March stays. If I look at that, by December 31st, we had 78,000 reservations on the books to stay in March. It's really almost 79K. When we go to 2025 this year, and we look at the 31st, we were only at 46,000 reservations. So pacing substantially slower to start the year out. That's a big red flag. We're obviously a little late now, but I'm sure some of you noticed that pacing was a lot weaker as we turn the corner on the year. And when we look at it at the market level, that is a substantial difference, 79,000 versus 46,000. Now let's jump forward a little bit. If we go to the end of January, so a month later, we're at about 158,000. So 158K in 2024. For one, that's a pretty substantial amount of pickup. That's like more than double. So lots of pickup happening in January in 2024. Let's hop over to 2025 and see what we got here. So we look at January 29th and we have 118,000. Now, this is pretty interesting because one, we are still trailing. We are still pretty far behind on gross booking amounts. You can see it when you look at that occupancy data for March. A lot of it is just not appearing. However, the pace itself seems to be on pace. So even though the early bookings seem to be missing, the January 2025 bookings are coming in quite fast. Now, gross amount, it's still a little lower, but in fact, the pace might even be higher. We more than doubled what we had on the books to start the year by the end of January. And you can kind of see it in this line, right? There's a pretty big jump up from November to December. And then from December to January, it's just been shooting through the roof. So lots and lots of pace. Whereas you can see in 2024, this is just much more gradual. However, this line starts to tilt up a lot earlier in October. It starts to tilt up a little higher in mid-December. And then it's just more gradually up. So I think what's interesting here is we're really like missing a month of serious pickup, and that's around the election. But the question is that revenue going to appear, or are those guests just missing? The other kind of question is, even if they do appear, are property managers going to be in a position to actually optimize ADR well? My guess is no. When we get into the short term in this industry, we don't tend to do that. Now, let's just look at where we are today or yesterday. So we'll look at 215. This year, we're at 169K. So again, another substantial increase in 2 weeks. So we just have an increasing amount of bookings coming in. When we look at 215, we're at about 212K. So, I think the story here is this market just started out behind on pace. It's continuing to be behind in pace for May. We maybe are a little distracted because January and February's pace looked pretty good, but I think everyone really needs to take a hard look at May and make sure that you're pacing. There's a chance, because we have seen that there's been pretty increasing amounts of bookings coming in for March, but it's last minute stuff. We're on the verge of being last minute, and that ADR is going to collapse. I really think that as a revenue manager looking in Orlando, you really want to pay attention to driving as much as you can in March, and then shift some of that attention to April and May and see if you can get ahead of it. If you can get ahead of the consumer there and drive occupancy, there's a chance that you can make up some of the revenue that appears to just be missing from March from a stays perspective. I hope you found that really valuable. I really love looking into the data, and this data is available if you go to Wheelhouse. All of this market data is available for all people, and if you would like to take a deeper dive into your data, please contact the team at Wheelhouse. We're love to show you how you can use our sets tool to get even more granular and look at very specific neighborhoods and specific property types within this. Or if you'd like to talk through how this data compares to your own portfolio's data, we'd love to have a conversation. Anyway, feel free to shoot me a message. Let me know what you think is valuable. And if there's anything else you'd like to hear from me or dig into, would love that feedback. Thanks and have a great day.